Wealth Our Way Nation. What is going on? It is your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform Wealth Our Way, where our motto is wealth is not only for the wealthy. This is a special edition. Normally I come to you every weekday, 12:30 p.m. Eastern with 15 minutes of finance. Tonight, on Thursday, October 14th, 2021, we got something special for you. We have a webinar that is basically just bringing honor and celebration to our 1-year anniversary. It was 1 year ago today that we had our launch party and we brought Wealth Our Way to the internet, to the world, for everybody to know and see what's up. I'm so happy that a year later, the nation has grown. I'm so happy that a year later, I'm still happy and pleased and just spunked up every day to come out here and give 15 minutes of finance and other levels of financial literacy. Tonight, we have part 1 of a 3-part webinar. This is going to be on all things life insurance. There is not going to be one question that you have about life insurance that will be unanswered if you choose to not ask it, that will be unanswered by the time we are done this 3-part webinar. We're going to go 45 minutes each night. And what I want to do is I want to leave time at the end for Q&A. That's why it's broken into 3 parts. I think that's palatable, digestible, and everybody can handle that amount of time talking about life insurance. I've presented many times over on various topics of life insurance. Questions always abound. People don't know who to trust. People don't know where to go. I sold life insurance for many years as an agent at New York Life Insurance and then a broker elsewhere. I've been in financial services for 24 years. I wanted to give you, the world, an opportunity to learn everything about life insurance and to ask any questions you have regarding life insurance without any pressure of worrying about if somebody's trying to size you up for a sale or not. This is going to be a fun evening, and we're going to get right into it because I have a lot of information to share. So now here comes the technology. Let's see if I do the screen share correctly. So if I go here, you are now seeing part me, part the presentation. I'm about to run it though. I'm about to go over to the presentation and make sure that everything is running. I will check, somebody's going to have to text me. I know my people here know me, to make sure that the slideshow is running properly. So right now, and I will wait for a text before I move further. Right now, you should be seeing a screen that says All Things Life Insurance presented by Charles Tank Harris, Wealth Our Way. And if I'm truly blessed, off to the left of that screen, you may still see even a little picture of myself verbally talking to you. If somebody could just text me who knows me and say, Tank, that is exactly what we see, I will feel comfortable to get started and move through the presentation. The last thing I want to do is talk for 45 minutes about life insurance and know that people are not seeing what I want them to see. I got the nod. It is time to go. First thing we always have to do is give you guys a disclaimer. Wealth Our Way provides this content to you for informational and educational purposes only. Entertainment is also going to be given to you because I'm a jovial dude and I'm going to make you laugh throughout the course of the evening. But this is not intended to be a sales solicitation. This is general information. If you have a situation for yourself where you're ready to go buy some life insurance, you need to consult a licensed professional. What my firm does is help people connect with licensed professionals, but we don't sell life insurance. I had the ability. I have been a member of the $1 Million Roundtable. I have sold hundreds of millions of dollars of face amount of life insurance, but I don't do that anymore. I am your friend in the business. I'm the person who helps you learn what you gotta have. So let's go and make sure that, I think I might want to reverse the size. I think I want to make me smaller and the presentation bigger. So give me 1 second while I figure out how to do that. I apologize. I want to go where I'm small. There we go. That's what I want to do. And now we're going to go back to the actual broadcast. And I'm going to resume the slideshow from the current slide. So now my head should be small and the words should be big. My head's big enough without making it the bigger part of the screen. What is life insurance? Life insurance is a contract between an insurer and a policy owner. It's that simple. An insurer, if you really want to make sure you get paid one day, an insurer is a life insurance company. Now, this will go high level before these 3 days are over, but I am starting to keep it as ABC simple as I can until we get to the more complicated parts. There are insurance companies that are captive, that are reinsurers. There's a lot of elements to insurance that I promise you the average person and even the above average person never needs to know about. What you need to know is that a life insurance company will have a contract with an owner of a policy, and those are the two parties to the contract. Life insurance guarantees a payment to a designated beneficiary. Also understand this about guarantees. Guarantees are only as good as the people who are making those guarantees to you. So when you make sure you purchase a life insurance policy, you want to make sure that one of two things, or maybe both things, is happening. One, they are a member of their state assurance, a guarantor company, that the state is backing them in case they default on their obligations. And two, that the company itself has reserves and has a great rating so that you feel very comfortable that the money that you are putting in this policy will be returned to you and your family. There are three parties to the life insurance contract outside of the actual company, and that is the policy owner, the payer of the policy, and the beneficiary. Sometimes more than one person can be a beneficiary. Sometimes more than one person can be a payer, but only one person or entity can own a policy. So when you see policies and you think, joint with rights of survivorship, that is not the case. A policy is owned by one person, and then the number of lives they have on the policy may be different. So one of the things that I teach people when we're talking about life insurance is only the policy owner can make any changes to the policy whatsoever. I've gotten phone calls when I worked at New York Life from people who had asked me, hey, Tank, my mom has this policy on me. I think I want to change this one. Your mom has to change it. If your mom owns the policy, your mom has to change it. The next thing we want to talk about is why have life insurance? Let me give you actually a little trivia before we move into that. Do you know that the earliest life insurance policies trace all the way back to the Roman Empire? It was, and I'm reading from some notes that I have here, apologize, I didn't memorize it. Caius Marius was the first Roman military leader to make a burial club. So he basically came up with the concept of life insurance to make sure that his fallen soldiers' families didn't have to bear the cost of their funerals. So all of the people in the army contributed something in a burial club to bury their fallen brethren. I think that's dope. What I really think is dope, you guys know where I'm from. I'm a Philadelphia type of cat. Philly was the first place in America to have life insurance. There was a life insurance was made by the Presbyterian Synod of Philly. It was made for the benefit of the ministers of the Presbyterian Church. Why would you want to have life insurance? A life insurance policy allows you to transfer your financial risk to someone else. So we all have risks that we are responsible for. We have people we have to pay for. Wouldn't it be nice if someone else would take your responsibility? A life insurance policy allows that to happen. Now, anything such as a transaction where someone's taken your responsibility, that costs money. So you pay this person to take your risk. If your risk is that you make $100,000 a year and your family is counting on that $100,000 a year for the next 20 years, you're on the hook to your family for $2 million, so to speak. You can transfer that $2 million of risk to a life insurance company for a cost of a premium to make sure that if something happens to you and you're no longer here, that $2 million will go to your family. It provides a tax-free payment to named beneficiaries. You see the little asterisk there, because that tax-free part is something very, very important. I don't know how many you guys and girls are watching what's going on with President Biden and the different estate plans and different tax structures that he's proposing to Congress and the Senate. But the tax-free portion is income tax-free. When you get that $2 million, it is not included in your income. However, when you own a life insurance policy, it's like owning a car. It's like owning a house. You own it. It's part of your estate. And people, when they inherit money, the estate taxes come off the top of the estate before they get their money. So for high net worth clients and people who are buying a lot of insurance, we will often structure their insurance policy inside of an irrevocable life insurance trust so that they no longer own it. If they don't own it, now it's free from all the taxes. It's free from income tax. It's free from estate taxes because it's not part of their estate. Speaking of the word estate, life insurance creates an estate for you for pennies on the dollar. So let's say you're a hardworking person making $20 an hour, and on average that's about $40,000 a year. $40,000 a year after you pay taxes, after you pay living expenses, God forbid, have a couple kids, you don't have a lot of money to grow a future financially. Yet you want your time on earth to financially have been represented, and you want to leave a legacy to your family. You can take a small portion of money on a weekly, monthly basis, lump it together, pay an insurance premium, and end up with an estate upon your death. 250,000, 500,000, $1 million. And it's pennies on the dollar when you think about, especially if you're using term insurance and you actually die during the term. We'll get to that tomorrow. But if you are buying term insurance, the leverage is incredible. If you're buying permanent insurance, the leverage is not as awesome as with term, but it's still a good return, as well as the fact that you'll have cash value in the policy, which we will also talk about on a future webinar. Most likely we'll get to that on Saturday. So who provides life insurance? Well, this is a very loaded question. People talk to me all the time when I tell them they need to have life insurance. They say, I got life insurance through my job. Because employers often will provide their employees with group coverage. I'm going to talk about group coverage tomorrow night when I talk about the different types of insurance. Today is basically the who, what, where, when, and why of life insurance, and to get the questions percolating. But group coverage is coverage that you get through your job. More often than not, you don't have to provide any proof of insurability. They're underwriting. Underwriting is the process in which they determine whether or not you qualify for insurance. They're underwriting a group. They're taking the risk of the group overall, and they're putting a price to it. So for group coverage, I tell people this example all the time. Your boy Big Tank is a big guy. If I buy individual life insurance, I'm rated very poorly because of my size. If I get it at my job, where the average rating is slightly below average, but not as bad as if I got it individually, it's cheaper for me to get it through my job. Conversely, if you are a relatively healthy and young person, job insurance is a little more expensive than buying it individually. The fortunate thing about employer coverage is the first 1 to 3 times salary is normally free. Then after that, they offer you what's called supplemental group coverage, where you can continue to pay some extra money and get more than 3 times your salary. There are 2 different types of insurance companies. There are mutual insurance companies and there are stock insurance companies. The delineation between the 2 companies is very important to understand. When you are with a mutual life insurance company and you own a policy, you are actually also an owner of the company. As such, when that company makes money at the end of the year, it will declare a dividend, and it will give that dividend to all of the policyholders. That is a beautiful thing. The other thing about mutual companies is when they go to market to try to raise money, they don't have the ability to raise money like a stock company does. They can't issue more shares of stock. So they raise money by making sure they can sell more policies. When I was at New York Life, it was a mutual company, had a huge sales force. All we did was sell life insurance. Why is that a good thing? Most people hear sales and they say that's not a good thing. It's a good thing because if your main stream of income is only going to be from selling policies, you have to have a high level of customer service. You have to have a high level of retention. You tend to see in mutual companies a better customer service experience, in my opinion, than when you see in stock insurance companies. Stock insurance companies can raise capital by selling more shares of stock. But here's the thing about all stock companies, not just stock insurance companies. The number one person that a stock company is beholden to is the stockholder, not necessarily the employees or the policy holders. If I own 100 shares of Coca-Cola and I'm a Coca-Cola shareholder, I have a dilemma, because I want Coca-Cola to go up, but I drink Coca-Cola. So I don't want the price to go up too much because now I'm paying more, but I'm making more over here. It's a very similar dilemma for stock insurance companies. They want to make sure that their stockholders are happy, but they also want to make a competitive product that they can put to the life insurance market to compete with mutual insurance companies. When you are selecting insurance, my rule of thumb, and this is a big tank rule of thumb, this is a tidbit for you to take with you. If I am looking for permanent insurance, more often than not, I'm going with a mutual company. If I'm looking for term insurance, more often than not, I'm going with a stock company. And I'll explain that when we talk about the differences between term and perm insurance tomorrow. When should I get life insurance? Well, let me tell you this. When I sold life insurance, everybody wanted to talk about why I'm selling them life insurance. What's in it for me? Here's what I'll tell you. I don't sell life insurance anymore, and I still think everybody needs life insurance. I believe that babies, when they come out, instead of getting little 529 plans or other gifts, the first thing a kid should get from their uncle, their aunt, their grandmother, their sisters is a life insurance policy. Why? Life insurance is what is known as a discriminatory product. It is legally allowed to discriminate. What do they discriminate against? They discriminate against poor health and increased age. Your health is never better than when you're young in most people's cases. You get older, your health deteriorates for most people. You are never younger than you were yesterday. So if you have the opportunity to have a product that is priced on age and health, imagine how infinitesimally small the premium amount is for a baby. When you have a newborn baby, the cost of insurance is so small that it's negligible, which means if you're buying a permanent policy, which is all I recommend for juvenile, I wouldn't buy a term life insurance policy on a baby. If I'm doing a savings account inside of a life insurance policy, which is whole life, the vast majority of my premium is going to the cash value because the cost of insurance is so low. My grandmother used to say an ounce of prevention beats a pound of cure. That is the basic premise behind life insurance. I have a lot of stories in financial services, and here's one I'll tell. Good friend of mine, while I was working with New York Life, told me he wanted life insurance, told me he wanted to get it from me. This guy looks like the bill of health, 30 years of age, in his 30s, very, very slim built, just a great history of health for his family and for him. Put him through underwriting. I get a call saying that the client needs to call the underwriting department because they don't let me as the salesperson or the agent know someone's health issues. So this person, is a friend of mine. So after he talked to the underwriter, he called me and he said, basically he found out during the underwriting process that his liver had some type of cirrhosis and was literally about to just need to be removed. It was horrible. He was near death as a result of this. Another instance, I sold insurance to a former college friend of mine, and still a friend, former college schoolmate. And she learned during the insurance process that she had an ailment that was also something that she could pass down to her daughter. So we rushed and got her daughter life insurance before she got to the same age 20s and 30s where this disease starts to kick in her family bloodline. Once you have these problems, getting insurance is very, very difficult. That is the whole ounce of prevention beats a pound of cure thing. You don't want to wait. Besides for the fact that if you wait, it's going to cost more, even if you're healthy. What do you think about the fact that you may not be able to get it? I'm going to put Susie Orman on blast. It's not a life insurance example. It's a long-term care insurance example. Susie Orman, Dave Ramsey, these are people who sell fear in the financial services market for the most part, in my opinion. And they love to tell you what products are horrible for you. And because, like myself, they don't make commission when you buy the products. So if you're not going to make commission, it's great to tell somebody, oh, you don't need that. Come pay me for advice. I don't scare my people like that. What I do is I tell you what's good for you. I told you many, many times over, there is no such thing, in my opinion, as a bad financial product. What ends up happening when people say, oh, I got that and I should have never got it, that product wasn't for them. It was a bad financial marriage. But the products, there's a lot of different regulatory agencies that make sure these products are good products. But every product isn't for everybody. I can take a CD and make it bad for somebody. I can take the stock market and make it bad for somebody if their situation doesn't merit having that. Going back to the concept of insurance, when you think about long-term care insurance and what Susie Orman used to say about it, she said it was a ripoff. She said insurance companies were getting rich off of it. One day it came out, because what's done in the dark comes to light, that she actually decided to apply for long-term care insurance, must have started to think it was a good idea. And when she applied, she was turned down during the underwriting process due to a health issue. That's karma right there. You go tell people they shouldn't have something, you realize you should have it, you go to get it, you can't get it. And that brings me to the third point on this slide, which is life insurance is better to have and not need than to need and not have. My story personally about life insurance, when I was, I want to say 33 years of age, I bought a 10-year term life insurance policy from Prudential. I wanted, I think $3 million worth of coverage was the policy for 10 years. And my premium, because I'm a heavy set guy, was like $5,500 a year. And I paid it once a year. I didn't pay it monthly because I wanted to save money on the premium. When you pay over time, they charge you to pay over time. I paid that policy for 10 years. During that 10-year period, did I want to die? No. But what I felt was comfort, peace of mind. I felt like if I went up near my old alma mater in North Philly and something popped off, I didn't say I was ready to die that night, but I knew if I did, my kids were going to be straight. When I got on the plane to fly all over the country to serve my clients, I knew that I didn't have to worry about if the plane went down, my kids would not have the ability to take care of themselves. So life insurance is not death insurance. Life insurance provides peace of mind. It also can be a very functionable tax solution for people who have high net worth. How do you get life insurance? So here's something that a lot of people don't understand. When I worked at New York Life, I was two things. I was a life insurance agent and a life insurance broker. How's that possible? What's the difference? An agent works directly for an insurance company. He is an employee, or she is an employee of that company. She can sell that product. A broker can sell you any company's product. When I first started at New York Life, I was deemed an experienced agent because I had over, at the time, I want to say 16 years of financial services experience. So I came in able to be both an agent and a broker. When you are new to the industry and you go to a company like a New York Life or a Northwestern Mutual, all you can do is sell their product. You are an agent. It's called being captive. You are captive to that company and can only sell that company's products. After about 3 years, you get to become an experienced agent, and now you can broker other companies' products. But the incentives financially for an insurance agent to sell their company's products is very, very good. I'm here to tell you, if the commission for a product was 50% at New York Life and 50% at, say, Transamerica, I was also given another 15% by New York Life if I sold their product, because I was able to get what was called sales allowance and other training expense allowances and contributions to my pension. So a lot of times, know who you're talking to. If you're talking to an insurance agent and they always keep telling you that this one company is always the solution, or even a broker, because you got to think about it like this. Brokers can negotiate their paid contracts with every carrier who they sell life insurance for. So as a result of doing that, they may have one carrier that's giving them 90% commission. Another carrier is giving them 35% commission. Guess what carrier is always going to be the one they think is best? The 90% one. So I don't say that to say that insurance agents and brokers are bad people. I am great friends with a lot of insurance agents and brokers. I was an insurance agent and broker myself for many, many years. It is like everything else in life. It is always buyer beware. It is always intelligent to educate yourself. The last place you can buy life insurance, of course, is just online. You can just go online, search for insurance, buy it direct. I would always say that you want to make sure you have the proper information. A webinar like this, being able to call a financial planner who can talk you through the A, B's, and C's of insurance can save you hundreds to thousands of dollars when you buy your policy. We are going to turn it over for Q&A right now. I'm going to come out of the screen share. I want to leave this up here for a hot second so that you guys will know that if you have anything outside of the webinar, we're going to put stuff in the chat. I'm going to answer it. But if you have any other questions after tonight, even after the whole 3-part series is over, you email info@wealthourway.com. or you call the company number 877-969-8265. We are on Facebook, which hopefully you're on watching right now, on our Wealth Our Way page, and we're on Instagram at Wealth Our Way. So let me come out of the screen share. Bang. Let me escape. And here we go. We're going to go and check on, let me get out of this. Thing is in my way. I don't like it. Here we go. So here we go. Now let me look at some of these chats and see if I got any questions here, and then also open it up for any new questions. Size is fine. Yes, it is. Love New York Life. All our children has policy. How do I qualify for underwriting? From Tashawana. So underwriting is the process of an insurance company determining what level of risk you pose for the insurance company. Sometimes the risk is too much and they decline you. Sometimes there's very little risk and they'll give you a great, beautiful rating. So I'm going to speak about New York Life's ratings to the best of my memory from when I was there. They had select preferred, they had preferred, then they had preferred 2, then they had standard, and then under standard, you were what was called rated. So you could have a non-smoking discount if you were standard. So you could be standard or non-smoking. They were basically the same level. Non-smoking was slightly cheaper because there was a discount for not having nicotine. Once you got rated, they would go to the actuarial charts and determine how much the premium was for you to get this death benefit that you're applying for. So the underwriting process starts with you taking an application with an insurance company, a broker, an agent online, and saying, I want this much insurance. And let me say this, and I'm going to put this in the chat, and we'll talk about this another time as well. Lifehappens.org is a nonprofit insurance-based entity that teaches you a lot about insurance. So if you can't get everything you want from me over these next 3 days, do know that lifehappens.org has all types of human value calculators, all types of articles on insurance. Last month was Life Insurance Awareness Month. As a result of it being Life Insurance Awareness Month, Kelly Rowland was one of the ambassadors for life insurance, lifehappens.org. You can just learn a lot of information there. So underwriting, you qualify for that by starting the application process. What is the advantage of universal life? I love Tamika Richardson. This is she's a Wealth Our Way family member, but she always is too smart for the content that I'm providing for the evening. I am going to talk about universal life when I get to permanent insurance, but because Tamiko asked me tonight and we got time, I'm going to talk about universal life a little bit right now. To talk about universal life, I have to talk about the difference between term insurance and permanent insurance. This is a good precursor for tomorrow night's lesson. Term insurance is insurance that is set to be priced under a contract for a certain number of years. I'm going to say that again slowly. Term insurance is a policy, it's a contract that is priced to a predetermined number of years. Why do I say it like that? Why do I not just say it's a policy that lasts a certain number of terms, a certain number of years in its term? Because it doesn't. So let me say this to you. Let me give you that same example I gave you about my Prudential policy. I bought a 10-year Prudential term policy in 2003. In 2003, I didn't know as much about life insurance as I know now. So what did I think happened at the end of 10 years for my Prudential policy? I thought it went away. It served its purpose. I bought it for 10 years of coverage. At the end of 10 years, I didn't, get it for 11 years, so it goes away. Not so fast. I got a letter in the mail and a bill for year 11. I was like, oh, cool. I can keep this policy. The problem was the same premium. I told you it was like $5,000 and some change. In year 11, when they sent me the bill for year 11, somebody put in the chat what they think the premium went up to. I'm going to give you a hint and let you know it went up. Somebody put in the chat how high they think it went up. While I'm waiting for that answer, I'm going to read Sister Lindsay's question. If you wanted more insurance, do you think it's best to invest on your own policy outside of work or buy an extra policy at work? I'm going to answer that after we finish with this universal life question. $35,000 is almost exactly the number. I must have told this story before and you got a great memory. But yeah, it was like 34 or 36 grand. It was ridiculous. I ripped that bill up and threw it right in the trash. And then as I continued working at New York Life, I learned what happened. The reality is this: when they price your term insurance for the set term that you agree to, they feel as though the underwriting, going back to underwriting, will cover them for this term, and they price it accordingly. In year 11, they don't know what's happened to you. You may have come down with some life-ending ailment. The only way they're going to know is if you go through underwriting again by getting a new policy. So if you choose to keep the existing policy, the rates go way up because the actuaries figure if they price it this high, one of two things is true. The increased rate that they're paying is commensurate with the risk the insurance company is taking, or the person will realize they're in better health than someone who needs to pay $36,000 a year, and they'll go back to the insurance company and get a new policy. Believe it or not, this is a true statement, and this goes against conventional thinking. An insurance company would rather you come back and buy a new policy, in my instance, in year 11, at a much, much cheaper premium than $35,000 than to insure me at $35,000. Why is that? Because they already know if I'm willing to pay $35,000 for coverage, I just found out I got cancer, AIDS, or something that's going to end my life in a short period of time, if not medically controlled, medicine controlled. And I would pay anything to keep that insurance intact. They know I probably don't have a lot of years left, and they're going to end up paying a lot more money than I paid in. So they would prefer that you come back to the table at the end of your term. Term insurance can be 5 years, 10 years, 20 years. They even have 30 and 40-year term insurance, and I'll talk about why that's not a good idea tomorrow. Permanent insurance, on the other hand, is insurance that is not bound by a term. This insurance is supposed to be with you forever. And in the realm of permanent insurance, there are two major big boys over there. There is the whole life chassis, and there's the universal life chassis. Here's the quick and dirty differentiator that I'm going to give you tonight before we get into it over the course of the next couple of days. Whole life insurance and universal life insurance have both an insurance component and a cash value component. That's how they're similar. Here is how they're different. Whole life insurance products actually figure out what your cost of insurance is all the way up to you're supposed to die. They give you an average number, and that becomes part of your premium. It's set, it's level for the rest of your days of paying your premium. So your insurance consists of that number plus whatever portion will go to credit your cash account. Universal life is not priced like that. Universal life still has the two components, but the insurance component, they price your life based on today. They price your life like term insurance. Why is that important? Why should you know this? And why can you get fooled with this? Because if I walk into your house as an insurance salesperson and I say, hey, you want permanent insurance? Yeah, I want permanent insurance. I want insurance that I can't, outlive. Okay, here's a whole life policy that'll give you $1 million of coverage. Oh, great. I love it. $1 million is great. The price is $15,000 a year. Oh, wait, I can't afford that. Okay, I got another policy that you can't outlive that's permanent, and it's only $4,000 a year. Oh, well, you should have led with that. Sign me up. How is it possible? It's possible because the universal policy has a cost of insurance that is significantly lower today than the whole life policy. What the person normally doesn't tell you is that every year, the cost of the insurance inside of your universal life policy goes up because term insurance goes up every year. There's a cost associated with your mortality. And as you get older, it goes up. This is why they take the cash component part of your premium, because they put it into a bucket. They give you a predetermined interest rate on that bucket of cash. And as your cost of insurance goes up, they take the premium you sent in and a little bit from the cash bucket, put it together, and that meets your premium. That is how you are able to have a product that starts off dramatically cheaper to insure yourself than whole life at a lower premium. Whole life insurance, that same bucket of cash that you put into and that the insurance company put into, you can take from that bucket later in life and do whatever you want with it, and your insurance policy will still stay in place. Universal life, if you look at that bucket of cash and you say, oh, it's $7,000 in that bucket of cash, I need $5,000 right now. You take that $5,000 out, I can promise you, you are going to get a letter from the insurance company saying, that's cool, glad you took the $5,000. I hope you're enjoying Fiji. But your premium next month is the $4,000 you've been used to paying plus another $3,000 because you don't have any cash reserve to meet your increased premium. So there are advantages to buying universal life. The one I just said was it's a lot cheaper for the same amount of face amount to get universal than to get whole life. But going back to my statement about there being no such thing as bad financial products, only bad marriages, universal life is the most confusing life insurance available to people. As a result, no insurance company sees more lawsuits come across their desk than over universal life policies, especially index universal life policies, because they're very confusing, very hard to understand, and they make the most sense for a very small portion of the public, but they're sold to everybody. So eventually somebody's going to get it, realize they didn't understand it, lose money that they thought they were going to get, and they're going to come back wanting to sue somebody. And that's why some companies refuse to sell index universal life, because of the liability. How do you know if it's worth it to start insurance for people over 60? This is where it helps to be a financial professional. So I literally do financial forecasting for people, how much you can save versus how much you would want to create an estate through insurance. The reality is that normally when I sit a new client down, this is especially something I did when I sold insurance, but I still do it now today when even not in selling insurance. I ask somebody, what do they think they're going to need in retirement? And then I help them actually figure out the number so they're not left to just think about it. We need to get to this number so that we can take X percent off of it so that you can pay your bills. That's what we need to get to. It's a formula. We start with here, we need to get here, and here's what I'm going to put away, and it's going to grow at X percent. Mission accomplished. I then tell them, as they're looking at that graph, there is a couple of things that can happen. There are a couple of things that can happen that can make it so we never get to the end of this. And those things are, you could become disabled, you could die. There's a couple other things, but those are the two I deal with because those are the two things I can help you with. If you become disabled and you don't have the same income to come back here and put this money in this thing that's growing for your future, there's an insurance policy that'll protect you against that. If you die, if your number was $2 million and we set up that you have to put away $1,000 a month for the next 30 years at 8% to get to $2 million, and I show you, but if you die at 48, you're not going to get there. However, you have a $1.5 million life insurance policy to make up the difference. This is a very easy example to sit in front of somebody and show them actually how it works. So if you're over 60, nothing changed but the number. I can show you the same way at 60 as I can show you at 50, 40, or 30. So there are many, many people who don't get big life insurance policies for the first time until they're after 60. Why is that? Because most of the high net worth people, it took them a long time to accumulate their high net worth. So they are 60. Now they're looking at a tax problem. If Biden rolls back the estate tax exemption, and we'll go back to, let's say, $1 million per person, you know how easy it is to have $1 million? I mean, I know we're all not balling, but the average American buy a house, hold it for 30 years, it went up, they got some stocks, a 401k. But I know people who have trash men, linemen at utility companies that have retired with $2 million, $3 million. Like, it's not hard to get $1 million by the time you're 70 if you go to Wealth Our Way, shameless plug, and learn how to save and invest over the course of your lifetime. So in doing that, you may say at 60, it's now time for me to deal with my estate tax because I'm going to leave all this money to my people and I don't want them to pay taxes on it. So as a result, I got to get an insurance policy that I'll pay pennies on the dollar for them to get the money free of taxes when I pass. Let me answer Lindsay's question. If you wanted more insurance, do you think it's best to invest in your own policy outside of work or to buy extra on your work policy? I am anti-work policies. The reason I'm anti-work policies is because there are restrictions on the portability of them when you leave. Sometimes you have to get underwritten all over again because, once again, remember, it was a group policy. So now if you aren't part of the group, you're a different risk for the company, the insurance company. Also, you don't know what that new price may be, not if you successfully navigate underwriting. So what I tell people is take the free stuff. Always take the free stuff. Your job is offering life insurance, take it. Now, as far as getting the rest of your insurance needs met, if you are healthy, it's always better to go and buy a private individual life insurance policy. If you are unhealthy or even, dare I say, uninsurable, get everything your job will offer you. Make sure you read the policy and the terms and conditions of the policy to know that if you sever employment, if you get fired, if you change jobs, whatever the case may be, how you keep your coverage intact. Nothing worse than paying into a policy for 20, 30 years, leave a job and realize they're not going to cover you afterwards. So always make sure that that is the case. Man, I love the night. We got 2 minutes to spare. I'm going to tell you like this. This was the high level what insurance is. Tomorrow, I'm going to get into the nitty gritty and into the weeds, and we're going to learn some real things. I want you guys to bring your questions. I want you to ask, because in this forum, you are safe because no one's going to turn around and say, ooh, she don't know. I can sell her this now. I can sell him this now. No, you're going to get knowledge here and nothing else. So I appreciate everybody for showing up. This will be indelibly burned on the internet forever, always at the Wealth Our Way YouTube and Facebook pages. But I thank my nation for showing up and supporting. Tomorrow night, 6 o'clock, same time, same bat channel. So with all that being said, I want to thank each and every one of you for attending tonight's webinar. And I want to remind you, as I always do, wealth is not only for the wealthy. You guys have the greatest evening. Talk to you tomorrow.